activated.
Cryptocurrency. These AI tools, they're marketed everywhere as like the essential thing for any modern trader. They promise you this edge, right? Faster execution than any human, and maybe the biggest draw, taking human emotion out of the picture. But that brings us to the core question, the one we really need to dig into today for you, the listener. Maybe you're prepping for a big meeting about this stuff, or perhaps you're just curious if that, I don't know, $100 a month tool promising easy profits is actually worth clicking subscribe. We've got to figure out, is AI in trading a real game changer? Is it delivering actual consistent results? Or is it mostly just, well, sophisticated hype?
A really clever marketing angle to get you to pay those fees. So that's what we're doing in this deep dive. We're going through the source material you sent over, breaking down the real benefits, the critical limitations people often forget, and the very different results we see, comparing the giant hedge funds to the everyday retail trader. And hopefully by the end, we can land on how you should realistically approach these tools. So maybe let's start by just defining what we even mean by AI in trading. It sounds like a big umbrella term.
It really is. And what's fascinating here, like you said, is people often picture this one single all-knowing robot doing everything. Research, trades, the lot. But the sources make it super clear that's not really how it works. It's not monolithic. It breaks down into, broadly speaking, two main types, serving pretty different roles. The first one gets most of the headlines, probably because it sounds so futuristic, so fast. Algorithmic trading.
Right, the automated stuff.
Exactly. This is where the AI isn't just giving advice, it's actually, pulling the trigger, executing the trades. So algorithmic trading uses these complex models, sometimes AI, sometimes just advanced math, really, to automatically place buy or sell orders based on rules you set beforehand.
Like what kind of rules?
Oh, things like specific price levels being hit, or maybe certain technical indicators crossing over, or even sudden jumps in trading volume that signals something might be happening. The whole point of this kind of AI is just pure speed and efficiency. These systems can process unbelievable amounts of market data, like hundreds of thousands of updates a second, way faster than a human brain can track. Yeah, so they spot tiny patterns or price differences almost instantly and execute the trade right then and there. This is really the heart of high-frequency trading, HFT, where speed isn't just seconds, it's microseconds.
So it's like a self-driving car, but for trading. You set the destination, the rules, and it just goes.
That's a great analogy, actually. It handles the driving with lightning reflexes. And just to give you a sense of how critical speed is here, these HFT firms, they don't just get faster internet. They literally pay to put their servers physically inside the same building as the stock exchange's main computer.
No way.
Yeah, it's called co-location, just to cut down the data travel time by milliseconds. That's how much tiny fractions of a second are worth in that world.
Okay, so that's the super fast automated execution side. What's the other category?
Right, the second one is probably more relevant for most people listening. It's AI-driven analysis tools. Now, these usually aren't making the trades for you. Their job is to give insights to you, the human trader. Think of them as like hyper-efficient research assistants.
Okay, so how do they do that? What kind of analysis?
Well, they pull information from tons of different places at once. We're talking scanning, like thousands of news articles, digging through dense financial reports, looking at historical price charts, and this is a big one, checking the mood on social media.
Social media, like Twitter.
Exactly. Twitter, Reddit forums, financial blogs, all in seconds. They're looking for shifts in market sentiment. A key technology here is something called natural language processing, or NLP. The AI doesn't just count keywords, it tries to understand the context and the tone. Is this news positive? Negative? Is this influential account bullish or bearish?
So it's reading the room, basically.
Precisely. It can tell the difference between, say, real market-moving news breaking and just random noise or speculation. And the output for you, the trader, is usually alerts like, hey, this event might impact your stock, or we're seeing a weird pattern connecting these two assets. Stuff that would take a human researcher ages to find manually.
Kind of like a superpowered weather forecast for the market, using past data and current conditions to predict storms.
Another good analogy, yeah, it helps you see potential trouble or opportunities coming. But, and this is really crucial, we need to flag this early on. Just because an AI can process data faster, or send you an alert quicker, that doesn't automatically mean you'll make more money.
Right. Speed isn't the same as being right.
Exactly. Speed is definitely an advantage, no question. But it's not a magic bullet. Remember the self-driving car. If you programmed it with a bad map or faulty directions.
It just crashes faster.
Precisely. Speed just guarantees you execute your flawed strategy more efficiently, potentially losing money faster.
That's a really important point. The difference between doing something fast and doing the right thing.
Yeah.
Because automating bad decisions,
Yeah.
that gets you nowhere useful.
Yeah.
Okay, but let's pivot now. Let's look at the arguments for it being a game changer. The undeniable advantages the source material highlights, where the hype maybe actually lines up with reality. The first one's the most obvious, I think, the speed advantage you mentioned. Our sources really hammer this home. In those really fast markets, Forex, futures, and definitely crypto, where prices can swing wildly in minutes, every single millisecond can matter. We're talking about opportunities that might literally only exist for a fraction of a second.
Tiny price differences between exchanges, for example.
Right. And AI doesn't just see these fast. It processes the info, makes the decision based on its rules, and hits execute almost instantly.
Sure.
We're talking under 100 milliseconds, sometimes way, way less.
It's physically impossible for a human to compete at that level. Click speed, reaction time, doesn't matter.
Exactly. It's not just an edge. It feels like a completely different kind of trading. It allows for things like micro-arbitrage, grabbing tiny profits from fleeting price discrepancies across different markets simultaneously. It's a structural advantage built on pure speed. Okay, so speed is huge. What's next? The second big one is data analysis superiority. Any experienced trader knows more information, timely information, usually leads to better choices. But the problem today, as our sources point out, is there's just an insane amount of data. It's overwhelming. Tech data, economic reports, company filings, global news, political shifts.
It's a fire hose, impossible for one person or even a small team to track it all effectively. Just too much noise.
Right, and that's where AI steps in. It acts like this tireless filter. It sifts through everything, 247. And it doesn't just summarize, it finds these complex, often hidden patterns. Connections that a human looking at charts might never spot.
Non-linear correlations sometimes.
Exactly, like maybe it finds a weird link between, I don't know, the price of oil and the trading volume of some tech stock in Asia. Stuff that seems totally unrelated to us.
Insights that come purely from having the computing power to check billions of possibilities.
Yeah. The AI sees the entire forest and every single leaf all at the same time. That ability to find signal in the noise is a massive advantage. And then there's the third one, maybe the most tempting for individual traders. Emotional immunity.
Ah, yes, the psychological edge.
This is huge, right? We know humans are often terrible decision makers when their own money is on the line. Fear and greed are powerful forces.
Absolutely. Classic behavioral finance pitfalls.
We panic sell when the market drops, hard selling right at the bottom out of fear. Or we get greedy when things are soaring, holding on way too long, convinced it'll never end. Until it does.
FOMO, fear of missing out and then holding on too long, yeah.
But AI, it doesn't feel fear. It doesn't get greedy or euphoric. It doesn't regret a missed trade or get cocky after a win.
Nope, just code and logic.
It just follows the strategy, the rules it was given, period. This removes those huge psychological errors that wipe out so many retail traders. It enforces discipline 100% of the time. Even if Bitcoin just tanked 15%, or your favorite stock is mooning.
That adherence to the plan, the stoicism, that's incredibly valuable.
It really is. Outsourcing that discipline to a machine, that feels like a superpower for most people.
It does. That speed, that data processing, and especially that lack of emotion, they make a really compelling case for the game changer side, but, and it's a big but. We need to slam the brakes a bit here, connect this back to the bigger picture. We have to look hard at the limitations, the real-world constraints that stop AI from being this perfect hands-off money machine. The biggest one, probably, is what our sources call the data dependency trap. Meaning the AI is fundamentally trained on past data. It learns by finding patterns in what has already happened. And as the sources clearly state, AI systems are only as good as the data you feed them.
Okay, so what's the trap?
The trap is that this reliance on history makes them incredibly vulnerable when something truly new happens, something outside the historical patterns they were trained on.
Like black swan events.
Exactly like black swan events. Think about a sudden major war breaking out, or a global pandemic shutting down economies, or a financial crisis triggered by something totally unexpected, like the 2008 housing collapse.
Stuff the AI has never seen before in its training data.
Precisely. or even just a major shift in the underlying market conditions. Imagine an AI trained for years during near-zero interest rates. Suddenly, inflation spikes, central banks start hiking rates aggressively. The whole environment changes.
The old patterns don't apply anymore.
Right. The model suffers from what we call model drift. Its predictions become less and less reliable because the world it was trained on doesn't exist anymore. History doesn't always repeat or even rhyme in ways an algorithm can predict purely from past data.
So the AI is basically driving using only the rearview mirror, which is fine on a straight road.
But disastrous when the road suddenly curves or, falls off a cliff. That historical perspective becomes a liability, not an asset, when faced with true novelty. The algorithm doesn't know the world has changed fundamentally. It just keeps applying the old rules.
So its greatest strength learning from the past becomes its biggest weakness in those unprecedented moments.
That's a perfect way to put it. And this actually flips that emotional immunity point on its head a bit.
How so?
Well, while taking emotion out sounds good, it also removes common sense, self-preservation. A human trader, seeing the market go completely haywire in a way they've never seen, might panic, sure, but they'd likely pull their money out, stop the bleeding, preserve capital.
Whereas the AI,
The AI, lacking fear or panic, might just blindly keep executing its now obsolete strategy, following the flawed historical script perfectly, right down until the account hits zero.
wow, that's sobering. So the lack of emotion isn't purely a positive.
It introduces a different kind of risk, the risk of automated self-destruction based on outdated instructions.
So the emotional burden doesn't disappear, it just shifts. It shifts to the human deciding when to trust the machine and when to pull the plug.
Exactly. Which requires judgment, which the AI lacks. And then there's the other big hurdle, a very practical one for most people listening, the financial barrier, the cost.
The subscription fees.
Yep, those high-end AI tools, the ones doing real-time sophisticated analysis or offering robust algorithmic trading platforms, they aren't cheap. We're off talking hundreds, sometimes thousands of dollars a month.
Okay, that's a significant cost, especially if you're just starting out or trading with a smaller account.
Huge implication. You absolutely have to do the math. If a tool costs, say, $300 a month, how much profit do you need to make just to break even on the tool itself? Never mind commissions or actually making money for yourself.
Right, you need a pretty significant return just to cover the software cost.
Many beginners fall into this trap. They spend more on the fancy AI tool subscription than they ever make back in trading profits. And frankly, a lot of what's marketed as AI to the retail crowd, it's often just, slightly fancier charting software or basic stock screeners with an AI label slapped on to justify a premium price.
So buyer beware, essentially.
Very much so. If you have, say, a $5,000 trading account and you're paying $150 a month for a tool, that's a 3% monthly hurdle or 36% annualized return just to pay for the software. That's a huge performance pressure before you even think about profit.
It makes the tool itself a big part of your risk equation.
Absolutely. So the question is the price worth it?
Yeah.
The answer is almost always it depends. It depends on whether you already have a solid, profitable strategy that the tool can genuinely enhance.
Not just hoping the tool is the strategy.
Exactly. If you don't have the basics down, risk management, understanding the market, an expensive AI tool probably won't fix that. It might just add complexity and cost.
That return on investment perspective is so important. And it really highlights the gap between the big institutions and the average person. Which brings us nicely to the real-world impact. Let's talk about those contrasting stories from the field. Because on one side, you have the titans, right? The institutional success story. The huge hedge funds.
The quant funds.
Yeah. They're not just using AI. Their entire structure is often built around data and algorithms. And the source material points to the legend.
Yeah.
Renaissance technology.
Rentech. Yeah, they're pretty much the holy grail in quant trading.
Their medallion fund.
Yeah.
The returns are just astronomical consistently for decades. It's often held up as the ultimate proof. See, AI is the game changer when done right.
And their strategies are famously complex and entirely automated, driven by data.
And this is the critical nuance our sources stress. The part that gets glossed over in the hype. Their success isn't just the algorithms, it's the human brilliance behind the algorithm.
Absolutely crucial point.
Think about what it takes to run something like that. Maintaining those systems, constantly updating them, debugging, preventing the AI from overfitting basically learning noise instead of signal from the past data.
Requires world-class talent, PhDs in math, physics, computer science.
Right. And humans still have to step in. They have to interpret the results, especially when something weird happens in the market, a geopolitical shock, a new regulation that might break the model's assumptions. They make the final call on strategy.
The AI is like a Formula One car, incredibly powerful, but needs a genius engineering team and a skilled driver overseeing it.
So it's AI plus massive human expertise plus incredible resources.
That's the trifecta. And that massive difference in resources and expertise is why the individual trader, the retail user, well, they face the retail reality check.
You feel like they're showing up to a Formula One race with a go-kart.
Something like that, yeah. They're fundamentally competing against firms like Renaissance, where the speed advantage alone, thanks to things like co-location, means most tiny arbitrage opportunities are gone before the retail trader's tool even sees them.
The HFT firms hoover them up instantly.
Pretty much. So because of this huge gap, the results for individual traders using AI tools are, well, they're all over the place, really mixed.
Some people love them.
Oh yeah, you'll find people who swear by a particular tool saying it helped them catch a big move or improve their consistency. Maybe they caught a good trend recently.
But others
find they just don't deliver on the big promises. They bought the hype, paid the subscription, and got maybe a slightly better indicator, but nothing revolutionary. Still requires a ton of work and judgment from them.
So if the super fast execution game is dominated by institutions and the results for retail are so mixed, is there any area where AI tools consistently offer real value for the average person? Where's the sweet spot?
Yes, I think there is. Where the value seems most consistent for retail, according to the sources, is in those market sentiment analysis tools we talked about earlier.
The ones scanning news and social media.
Exactly, because that's a task where AI provides something a human genuinely cannot do at scale, reading and interpreting millions of text sources in real time to gauge the overall mood.
How does that help practically?
Okay, imagine a company reports earnings and they miss expectations. Bad news, right? A human might just see the negative headline and think, sell.
Panic reaction.
Right. But an AI sentiment tool can instantly scan thousands of analyst reports, news articles, influential Twitter accounts, comments on financial forums. If it finds that the overall tone among sophisticated sources is actually quite calm, maybe saying this was expected or the underlying business is still strong, it can alert the trader.
So it provides context to the headline noise.
Precisely. It might suggest the potential downside is less severe than the initial panic reaction implies. Or, conversely, if sentiment is overwhelmingly negative, even after good news, it might signal underlying weakness. It helps you gauge the reaction to the news, not just the news itself.
Letting you avoid getting swept up in herd behavior, maybe.
That's a big part of it. It helps provide that layer of objective analysis about crowd psychology, allowing the trader to make a more informed decision, even if they're the one hitting the buy or sell button. That analysis layer seems to be where accessible AI tools can really add value.
That makes a lot of sense. It's using the AI for its strengths, mass data processing, and pattern recognition in language to give the human trader better situational awareness. But given this mix of potential value and, frankly, a lot of hype and mixed results, we absolutely need to tackle misinformation out there.
Oh, definitely. This brings up a really important question. With so much noise and aggressive marketing, how do you, the listener, filter it? What are the big myths about AI and trading that you absolutely need to ignore? Because believing these myths is probably the quickest way to lose your shirt.
Okay, myth number one.
The biggest one, hands down, is the idea of instant riches. Get rich quick.
The magic money machine.
Exactly. The sources are crystal clear. AI tools are not a get-rich-quick scheme, full stop. They do not, under any circumstances, guarantee profits. The excitement around automation makes people forget you still need a solid strategy, market knowledge, risk management.
All the hard stuff.
All the actual trading skills, yeah. And there's a real danger here. Our sources warn that blindly trusting an AI, especially if you don't understand why it's making certain recommendations, what people call the black box problem.
Right, just trusting the output without knowing the process.
Yeah, that can lead to really more risky behavior. Maybe you bet bigger sums because you think the AI can't be wrong. You override your own judgment or risk limits because the machine told you to.
So you're not managing risk anymore, you're just outsourcing decisions without understanding them.
Precisely. Remember, the AI tool is just that, a tool. It's only as good as the strategy you use it with and the risk rules you set around it. You cannot just outsource discipline or strategy entirely.
You're still the pilot, even if you turn on autopilot sometimes. You need to know how to fly the plane.
Perfect analogy. You tell the machine, buy XYZ. If the price does this and keep buying, it will obey, even if it's a terrible idea in the current context. Okay, so that's misconception 1, not instant riches. What's number 2? Misconception 2 is the belief in infallible accuracy. That the AI is always right because it has so much data.
But we already talked about the data dependency trap.
Exactly. While AI is amazing at processing historical data and finding patterns, it's still stuck looking backward. We talked about model drift when market conditions fundamentally change, like with new regulations, geopolitical shifts, or economic regime changes.
The old patterns break down.
Right. The correlations the AI learned might just evaporate. The core limitation, always, is that AI cannot predict the future. It can only make probabilistic forecasts based on past data.
It's sophisticated pattern matching, not prophecy.
Beautifully put. And when traders forget that crucial difference, they start treating AI signals as gospel, which is incredibly dangerous.
Okay, so not instant riches, not infallible. Got it. So after weighing the pros, the cons, the reality checks, where do we land? What's the verdict on AI and trading?
Right. Let's try and synthesize this into a clear takeaway. The conclusion is definitely nuanced. For the big players, the professionals, the hedge funds, yes, AI is absolutely a game changer, no question. It fundamentally changes how they operate. It enables speed, scale, automation, deep insights. It really has transformed institutional finance into, like, a computational arms race.
Okay, clear win for them, but for the rest of us.
For the everyday retail trader, you, the listener, it's much more complicated. AI tools are not magic bullets. They won't instantly make you trade like Renaissance technologies, they don't automatically level the playing field, and they are absolutely not a replacement for learning how to trade, developing a strategy, and managing risk.
So not a magic bullet, but maybe still useful.
Potentially, yes.
Hello.
The recommended approach, based on everything we've seen in the sources, is this. Think of AI as a specialized assistant.
An assistant, not the boss.
Exactly. Use it to complement your existing skills. Maybe it helps you analyze data faster or catch sentiment shifts you'd miss, or maybe helps manage the emotional side of hitting execute. But never, ever think of it as a substitute for your own critical thinking, your own risk management plan, or doing your own solid research.
It's like having a really powerful calculator.
Yeah.
But you still need to know which calculations to perform. You still need to understand the math problem you're trying to solve.
That's a fantastic analogy. The AI is the calculator, but you provide the formula and interpret the answer.
Okay, that makes sense. So wrapping this all up then, what are the key things you should walk away with from this deep dive? It sounds like the main message is powerful tool, but handle with extreme care and realism. First, we saw the real value comes down to two main things: blinding speed for algorithmic trading, mostly benefiting the big guys, and maybe more usefully for retail, that comprehensive analysis, especially spotting market sentiment shifts. The pros are real. Speed, data crunching, taking emotion out. Hard to argue with those.
Right, those are tangible benefits.
But second, we hit the big caveats. AI's Achilles heel is its reliance on the past, making it brittle during those unexpected black swan moments. And for many, the cost of those subscription fees can be a major barrier, potentially costing more than they help you make, especially early on.
The cost benefit has to be carefully weighed.
So the final call to action really boils down to discipline and skepticism, doesn't it? Our sources strongly advise approaching all the AI trading hype with a healthy dose of skepticism. Don't just believe the marketing.
Absolutely. Do your own homework.
Really dig into any tool you're considering. Understand what it actually does. Is it genuine AI doing complex analysis, or is it just a dressed-up screener charging a premium? And think carefully. How does this specific tool fit into your trading plan? Does it automate something you struggle with? Or is it just adding another layer of complexity and expense to a strategy that isn't working yet?
Good questions to ask.
You try free trials first. Low-cost options. See if it actually improves your results before committing serious money to the tool itself. There are even some open source tools or lower cost analysis platform using basic AI ideas that might be worth exploring.
Good practical steps.
Because ultimately it comes back to basics, right? Knowledge of the market, a solid plan, risk management, discipline. Those are still the absolute keys. AI is an amazing development, a powerful analytical layer.
But it just adds another layer of analysis, as the source said.
Yeah, it can enhance the cake, maybe add some fancy icing, but it doesn't bake the cake for you. You still need the core ingredients.
Well said. And that actually leads to a final, maybe provocative thought to leave you with.
Oh, come on.
We spent some time talking about Renaissance technologies, right? Their incredible success using automated quantitative strategies. The pinnacle of AI in trading, arguably. But remember that crucial human element we discussed. Even they, with all their resources and algorithmic genius, still rely heavily on human experts, the mathematicians, the programmers, the strategists to interpret the complex data, to refine the models constantly, and crucially, to make the final strategic calls when faced with true, unprecedented market uncertainty.
Right, the human oversight is still essential, even at the very top.
Exactly. So if the world's most advanced data-driven trading systems, backed by billions, still need human judgment to navigate deep, systemic market risks, what does that tell us? It makes you wonder, what is the irreducible minimum of human judgment needed in trading? Can that kind of macro risk management dealing with true unknowns ever be fully automated? Or is there always going to be a fundamental need for human intuition, adaptability, and wisdom when navigating the genuinely unpredictable future of global markets?
That ingurs it is a really deep question, something to definitely mull over. Where does the machine stop and human insight necessarily take over?
Exactly. That's the question that's probably going to shape the next decade of AI in finance.